The global extractive industry often operates within a crucible of unprecedented economic volatility and structural shifts. Market observers frequently note how sudden geopolitical realignments can rapidly alter commodity valuations. During the first quarter of the year, these exact macroeconomic forces shaped a unique financial landscape for major mining companies worldwide. For Freeport-McMoRan, a corporation that has long defined itself as a leading American copper champion, the recent reporting period was characterized by a profound strategic divergence. The primary industrial output faced significant operational headwinds, while the secondary output emerged as the definitive driver of financial outperformance. This complex interplay between catastrophic technical challenges at the primary minerals district and historic price appreciation in the precious metals market forged an unexpected quarterly result. The ensuing financial performance surprised industry analysts and highlighted the intrinsic value of commodity diversification within a single corporate asset class. The narrative of the first quarter is not merely one of higher prices offsetting lower production volumes. Instead, it represents a highly nuanced story of operating leverage and byproduct convexity. Exceptional gold prices transformed the underlying accounting mechanisms governing unit net cash costs for the business. Consequently, the corporation transformed into one of the lowest-cost copper producers globally. This remarkable cost reduction occurred despite the fact that its flagship mining operation was functioning under a declaration of force majeure for much of the period following a devastating and tragic underground mud rush. To properly understand the financial results reported on April 23, one must look at the extraordinary macroeconomic environment. The first quarter was defined by a rapid escalation of tensions in the Middle East. This geopolitical friction acted as a dual-edged sword for global mining companies. On one hand, the conflict drove up the price of essential consumables like diesel and sulfuric acid. This dynamic exerted significant upward pressure on site production costs. On the other hand, it ignited a widespread flight to safety that sent global gold prices into a vertical ascent. During January, gold breached the $5,000 per ounce resistance level and eventually peaked near $5,600 intraday. This historical price movement was not driven solely by temporary market fear. It was heavily supported by a structural reassessment of global sovereign debt stability. With federal debt exceeding 120% of gross domestic product, institutional allocators began viewing gold as a mandatory portfolio stabilizer. Central bank activity further amplified this major market shift. Central banks have been consistent net buyers of gold as emerging markets sought reduced dollar dependency. While gold provided a safe haven, premium copper demand was driven by the artificial intelligence infrastructure wave. The financial market firmly accepted that copper was the essential underlying production factor for artificial intelligence data centers. It is similarly crucial for power transmission and the broader energy transition. Research indicated that the continued surge in demand for compute power was creating a structural shortage globally. Analysts projected global refined copper deficits to reach 330,000 metric tons for the full year. This combination of safe haven demand and secular growth created a bullish setup. Freeport-McMoRan was uniquely positioned to exploit this environment, provided it could manage its recent operational disruptions. Realized commodity pricing trends illustrated the sheer magnitude of these market tailwinds. Copper realized prices rose over 30% to $5.78 per pound. Gold realized prices demonstrated an even more spectacular 59% increase to $4,889 per ounce. Molybdenum prices also experienced a 16% climb. This remarkable pricing environment directly influenced the byproduct credits deducted from the total cost of copper production. Such highly favorable pricing allowed the enterprise to report a significant revenue increase, reaching $6,234 million. This financial success materialized even as the company struggled with its most significant operational setback in a decade. The earnings beat easily exceeded Wall Street consensus. The corporation reported diluted earnings per share of 61 cents, significantly exceeding the analyst estimate of 46 cents. Adjusted earnings per share, which accounts for specific one-time items, was 57 cents. This dramatic earnings beat was fundamentally driven by the outsized contribution of gold sales. Net income attributable to common stock more than doubled to $881 million compared to the prior year. This massive increase in profitability during a quarter characterized by lower consolidated mining volumes is a testament to the convexity of the margin structure of the organization. When commodity prices rise considerably faster than the all-in sustaining costs of production, the incremental revenue flows directly to the bottom line. This financial phenomenon was clearly evident in the remarkable jump in net income. Cash flow generation was equally robust, reaching $1,500 million. This robust cash flow provides the company with the liquidity necessary to confidently fund its extensive annual capital expenditure program. Simultaneously, it allows the mining giant to heavily reward shareholders through sustained dividends and buybacks. As of the end of March, the net debt position remained extremely strong. Net debt stood at $2,400 million, which falls well within the target range established by management. This strategically under-leveraged position relative to corporate targets suggests that the company holds significant dry powder. The firm is perfectly poised for future acquisitions or increased shareholder distributions. The gold credit mechanism is incredibly critical for understanding unit net cash costs for copper extraction across the portfolio. In traditional mining, accounting revenue generated from secondary metals is treated as a credit against the cost of mining, the primary metal. This is the byproduct method. Consolidated unit net cash costs for copper during the first quarter were $1.91 per pound. This represented a massive improvement from $2.07 per pound previously. The raw site production and delivery costs were actually $3.29. The vast economic bridge between those two numbers was built almost entirely of gold credits. This gold credit effect was naturally most pronounced at the Indonesian operations. The company realized nearly $200 million in byproduct credits from gold and other minerals in Indonesia alone. On a per-unit basis, this provided an astonishing $2.39 per pound reduction in the cost of copper produced. Consequently, the Indonesian operation achieved a unit net cash credit of $3.53 per pound, defying all conventional global cost expectations. This brilliant mechanism effectively hedged the company against the troubling inflation of consumable materials. While military conflicts drove up regional diesel prices, the resulting safe haven spike in gold provided a natural offset that ultimately kept corporate profit margins at historic levels despite massive global economic uncertainties. Despite the stunning financial triumphs, the operational reality at the Grasberg Minerals District involved disciplined crisis management. This specific district serves as one of the largest copper and gold mine complexes globally. Operations have been severely curtailed since a catastrophic mud rush incident occurred last September. A mud rush in a block cave mine is a disastrous event where a mixture of ore and water liquefies rapidly. It enters the underground workings at high velocity, posing immense danger. The September incident involved an estimated 800,000 metric tons of extremely wet material. This massive slurry traveled rapidly through multiple mine levels, resulting in the tragic death of 7 dedicated workers. It caused significant damage to critical loading infrastructure deep underground. The corporation immediately declared force majeure and halted operations to conduct a completely thorough safety investigation and remediation. In the first quarter, the operational impact of this tragedy was exceptionally profound across the global portfolio. Copper sales from Indonesia dropped sharply to 82 million pounds from 290 million pounds a year earlier. Unaffected localized mines were fortunately restarted in late October. However, they were entirely unable to offset the massive production loss of the main block cave. This primary section typically accounts for roughly 70% of the overall district output. The central technical challenge facing engineers in the first quarter was the severe wet or handling bottleneck. The mud rush incident fundamentally changed the core moisture profile of the ore residing in the cave. Management explicitly noted that the crucial ramp-up has been vastly slowed by these newly wet conditions. The remediation protocol subsequently required extensive physical cleaning of hundreds of vital droplets. It also necessitated significant cleaning of the main haulage levels, where heavy machinery operates daily. Complex infrastructure upgrades were mandated, including heavily modifying the ore loading chutes and associated conveyor systems. These modified systems must safely handle material with higher moisture content without causing further liquefaction risks. Additionally, the company is actively installing advanced electronic sensors and robust physical protective barriers. These precautions are strictly designed to protect workers and expensive equipment in the unfortunate event of further sudden surges. These stringent technical requirements led to a highly significant revision in the annual guidance. Freeport-McMoRan cut its annual copper sales forecast down to £3,100,000,000. Its gold sales forecast was correspondingly reduced to 650,000 ounces. Expected production rates at the block cave are currently projected at only 65% of total capacity. Full capacity utilization is completely pushed back into late next year, representing a prolonged timeline. For the professional institutional investor, this clearly means that while the recent quarter was a resounding financial success, the company is still running at a massive deficit regarding its true volume potential. While Indonesia remained the strict focus of remediation efforts, the Americas portfolio provided necessary production stability. This stability allowed the firm to capitalize wonderfully on high commodity prices. The business owns strategic stakes in 10 copper mines scattered across the United States, Peru, and Chile. The portfolio includes the massive Morningside district in Arizona, which is the largest copper mine in North America. In the first quarter, the United States operations demonstrated remarkable overarching efficiency. Production in the region was up 5% compared to both the prior year and annual averages. This consistent growth is particularly impressive given the inherently low ore grades typically found in aging southwestern mines. This tremendous operational improvement was directly driven by two key internal initiatives. The first was standard efficiency gains, while the second focused heavily on innovative new leach recovery techniques. The advanced leaching technology has rapidly emerged as a highly meaningful value driver for the entire enterprise. Traditionally, copper is physically extracted through an energy-intensive concentrating and smelting process. However, leaching safely allows the company to extract precious copper from low-grade ore stockpiles effectively. These massive stockpiles were previously considered entirely useless waste material. By utilizing groundbreaking new chemical applications and modern data analytics, the miner is successfully crystallizing hidden value. This brilliant extraction is done with incredibly minimal capital investment, keeping long-term financial risk securely at bay. In South America, the vital Cerro Verde mine in Peru alongside El Abra in Chile remained highly stable. Total copper sales from the region are reliably forecast to match similar massive volumes seen last year. However, the broader South American region continually faced strong economic headwinds. Rising regional labor costs and escalating energy expenses pushed unit net cash costs to $2.57. This escalating financial pressure starkly highlights the absolute critical importance of the ongoing Grasberg recovery. The Indonesian mine produces massive gold credits that substantially suppress consolidated costs. Only the Asian asset is truly capable of bringing the overall consolidated cash cost down below $2. Meanwhile, the primary reason for the phenomenal surge in stock price was a widespread market reassessment regarding long-term demand. Copper has steadily evolved far beyond a cyclical material. It is now heavily regarded as a mandatory strategic resource completely necessary for propelling the modern global economy. Goldman Sachs identified the firm as possessing the absolute best-in-class exposure within the complex context of structural shortages. The artificial intelligence electrification pull remains a critical component. Data centers inherently form the core technological backbone of the rapidly expanding artificial intelligence era worldwide. These massive centers strictly require staggering amounts of high-grade copper for essential power transmission. Extensive distribution networks and sophisticated thermal cooling systems also heavily rely upon this versatile metal. On the supply side, the physical metal market is heavily characterized by acute supply disruptions. Beyond the devastating Grasberg mud rush incident, other major global producers have repeatedly faced severe operational challenges. The permanent closure of a massive Panamanian mine and declining ore grades elsewhere severely impacted availability. These concurrent issues essentially removed hundreds of thousands of tons directly from the global market. The underlying asset-level profit convexity of Freeport-McMoRan is therefore highly likely underestimated by the broader equity market. Any further marginal increase in copper prices will undoubtedly expand their corporate margins substantially. Despite their incredibly strong quarterly operational performance, the initial market reaction on April 23 was starkly negative. Shares suddenly tumbled over 8% during turbulent pre-market trading sessions. This rapid sell-off was certainly not a blatant rejection of the phenomenal earnings beat reported by corporate management. Instead, the drop primarily reflected an intensely skittish reaction to the newly revised downward output guidance. Anxious investors and short-term oriented traders hyper-focused on the lost production volumes at Grasberg. They heavily penalized the stock for the stated delay in reaching full underground operating capacity. However, overarching institutional sentiment across Wall Street consistently remains broadly constructive regarding the equity. Goldman Sachs proudly maintained a solid buy rating alongside a hefty $70 price target. Another major bank simultaneously raised its own target to an optimistic $76, reiterating an overweight view. The prevailing consensus rating among 22 diverse Wall Street analysts is currently classified as a moderate buy. 18 distinct analysts officially issued proactive buy ratings, while absolutely zero issued formal sell ratings. This intense valuation debate fundamentally centers on precisely how to view the underlying equity. While these sales may merely relate to standard estate planning, they unfortunately represent a potential red flag. Investors traditionally seek a strong alignment of interests between shareholders and corporate leadership. Despite this, management has firmly maintained a disciplined focus on operational execution and rigorous capital allocation strategies. The company successfully operates under a highly attractive performance-based shareholder return framework. During March, the board confidently declared a quarterly cash dividend of 15 cents per share. This specific dividend structure uniquely consists of both a steady base component and a flexible variable payout component. This ingenious variable component rewards loyal shareholders generously during lucrative periods of exceptionally high commodity prices. Concurrently, it provides the corporation with a much-needed financial buffer if volatile prices eventually retreat. Last year, the firm paid out an impressive $865 million. With operating cash flows actively projected to approximate nearly $8.7 billion, the current dividend appears exceptionally secure. Another massive strategic milestone flawlessly achieved was the Memorandum of Understanding with the Indonesian government. This critical agreement explicitly outlines a profound life of resource extension. This absolutely vital contract ensures continuous long-term access to the world-class ore body located deep within Grasberg. Key terms formally include an extension far beyond the previously established temporal limit. It additionally involves a specific 12% share transferred directly to Indonesian governmental interests ultimately. The enterprise will safely maintain its current substantial ownership percentage through the next 15 years, before dropping to roughly 37%. While this future reduction represents a slight leakage of total economic value, it decisively provides essential regulatory certainty. The company desperately needs this operational stability. Stability is strictly required to reliably invest multiple billions in ongoing underground block cave infrastructure development. Concurrently in the Americas, the organization is aggressively advancing extensive expansion options at both Baghdad and El Abra. The massive Baghdad expansion located in Arizona currently resides in a pre-investment phase. However, no financial analysis is ever entirely complete without a sober assessment of inherent risks. The first quarter provided an extremely humbling reminder of these very risks that could potentially derail sustained recovery. Geopolitical uncertainty and severe regulatory exposure constantly threaten the overall stability of mining enterprises. The unprecedented financial success driven by record gold prices stood in stark contrast to operational struggles. Grueling and dangerous remediation work taking place deep underground heavily clouded the otherwise bright picture. For industry peers, the quarterly results definitively confirm that this corporation is a diversified metal giant. Gold byproducts clearly serve as a definitive and powerful hedge against standard industrial volatility. The brilliant gold credit mechanism completely transformed a quarter of operational crisis into undeniable financial outperformance. By realizing astronomical gold prices, the firm lowered consolidated copper costs to incredibly profitable levels.